Did you know that during the 2008 financial crisis, while the S&P 500 plummeted by over 38%, consumer staple stocks only fell by 15%? That's a massive difference. And here's another shocking fact. Procter & Gamble has been paying and increasing its dividends for 67 years straight, through wars, recessions, and market crashes. These aren't just numbers. They're proof that investing in the right companies can keep your portfolio afloat when the economy sinks. But we're not talking about chasing the next hot tech stock. We're talking about the everyday essentials, like toothpaste, soap, and laundry detergent, that people buy no matter what's happening in the world. In this video, we're going to uncover why consumer staples are the unsung heroes of value investing. We'll dive into the strategies that make giants like Procter & Gamble not just survivors, but winners in tough times. And we'll explore hidden gems in the market that could add serious value to your portfolio. Ready to build a recession-proof portfolio that can weather any storm? Let's get started. Chapter 1. The Silent Heroes. Why consumer staples shine in economic storms. When the economy takes a hit, people tend to cut back on luxuries, but essentials like toothpaste, soap, and toilet paper stay in the shopping cart. This is where consumer staples come into play. Companies like Procter & Gamble, P&G, are the silent heroes in the storm. Their products are in our homes regardless of the economy. Think about it. No one stops brushing their teeth during a recession. Historically, consumer staples have outperformed the broader market during downturns. During the 2008 financial crisis, the S&P 500 dropped by over 38%. But consumer staples? They only fell by about 15%. That's a massive difference when you're protecting your portfolio. These companies are resilient because they sell products we all need, no matter what's happening in the world. Procter & Gamble is a perfect example. With over 180 years in the business, they've weathered every economic storm since 1837. The company's revenue didn't just survive the Great Recession, it grew by 7% from 2007 to 2009. Why? Because people still bought Tide detergent, Pampers diapers, and Gillette razors. These are products that don't go out of style or demand, even when times are tough. There's also a reason Warren Buffett has always had a soft spot for consumer staples. He once said, "Our favorite holding period is forever," and consumer staples fit that bill perfectly. They generate consistent cash flow and offer stability when markets are rocky. That's what makes them the bedrock of a recession-proof portfolio. It's not just about the products, though. The strategy here is to focus on companies with strong brand loyalty. People trust brands like P&G, and that trust translates to steady sales. When the economy is shaky, sticking with the tried and true names in consumer staples can keep your portfolio grounded. The data backs this up too. Consumer staples stocks have historically had lower volatility, which means less stress for you as an investor. To sum it up, consumer staples are your portfolio's safety net. They're the companies that quietly keep performing, even when the economy doesn't. By anchoring your investments in these silent heroes, you're building a defense that can weather any storm. Chapter 2. The Power of Everyday Essentials. Unpacking Procter & Gamble's secret sauce. Let's dig deeper into what makes Procter & Gamble a powerhouse in the consumer staples space. It's not just luck that they've been around for nearly 2 centuries. Their success is rooted in a strategy that's simple yet effective. Dominate the market with everyday essentials. P&G is a master of diversification. They don't just rely on 1 or 2 products. Instead, they own a portfolio of over 60 brands, each a leader in its category. From Crest toothpaste to Olay skincare, these brands touch every aspect of daily life. This wide reach is P&G's secret sauce. It spreads out the risk. If one product line faces a slump, others pick up the slack. This balance is key to their resilience. One of P&G's most brilliant moves was focusing on innovation within these everyday categories. They don't just sell soap, they create better soap. For example, their Tide Pods revolutionized laundry, becoming a billion-dollar product line. This constant innovation keeps their products relevant, even in saturated markets. It's a strategy that keeps customers coming back, recession or not. P&G's commitment to quality is another cornerstone of its success. They spend over $2 billion annually on research and development. That's more than some companies' total revenue. This investment ensures that their products are not only top tier but also ahead of the curve. When people trust the quality of a product, they're less likely to switch, even when money is tight. The numbers tell the story here too. P&G's return on equity, ROE, consistently hovers around 25%, which is a clear indicator of how efficiently they use shareholders' money to generate profits. This strong financial performance is what makes P&G a staple in many recession-proof portfolios. But it's not just about the numbers, it's about strategy. P&G's global presence is a huge advantage. They operate in over 180 countries, meaning they're not overly reliant on any single market. This geographic diversification shields them from regional economic downturns, providing another layer of security for investors. In essence, P&G has built a fortress around its business by focusing on what people need, constantly improving it, and spreading its bets globally. This strategy makes them a reliable cornerstone in any portfolio aiming for stability and long-term growth. When you invest in Procter & Gamble, you're not just buying a stock, you're buying into a legacy of resilience and innovation. Hit that subscribe button and let's keep going with the rest of the video. Chapter 3. Dividends that deliver. Creating a steady income stream with consumer giants. When it comes to value investing, dividends are a key ingredient. They provide a reliable income stream, which is especially important during uncertain times. Companies like Procter & Gamble are known for their strong, consistent dividends. But it's not just about the payout, it's about the strategy behind it. Dividends are a sign of a company's financial health. P&G has been paying dividends for over 130 years and has increased them for 67 consecutive years. That's the kind of track record that investors love. It's not just about getting a check every quarter. Dividends are a powerful tool for compounding wealth over time. Let's talk numbers. P&G's dividend yield is around 2.5% to 3%, which might not sound like a lot at first glance. But here's where the magic happens. Reinvesting those dividends can significantly boost your returns. Over the past 30 years, reinvested dividends have contributed to nearly half of the total return in the stock market. That's huge. This strategy is often referred to as the dividend snowball. It's a term popularized by Warren Buffett, who has famously used it to build massive wealth. The idea is simple. As you reinvest your dividends, you buy more shares. More shares mean more dividends, and the cycle continues, growing your investment exponentially over time. Procter & Gamble's ability to consistently raise its dividend, even during economic downturns, is what makes it a cornerstone in a recession-proof portfolio. When markets are volatile, having a steady income from dividends can provide a cushion against losses. It's like having a safety net that pays you to hold on. Another interesting fact is that companies that pay dividends tend to be more disciplined with their capital. They're less likely to take on risky projects and more focused on steady growth. This is exactly what you want when building a portfolio that can withstand a recession. In short, dividends are more than just a nice bonus, they're a critical part of a value investing strategy. By focusing on consumer giants like P&G, you're not only securing a steady income but also tapping into a proven method for long-term wealth creation. Chapter 4. Beyond the grocery aisle. Discovering underrated consumer staples. While big names like Procter & Gamble are essential, there's a whole world of underrated consumer staples that can add value to your portfolio. These companies might not be household names, but they offer something equally important: stability and growth potential. Take Clorox, for example. It's a brand we all recognize, but it doesn't always get the spotlight it deserves. Yet, Clorox has been quietly delivering strong returns for decades. During the COVID-19 pandemic, the company's sales soared by 23% as people stocked up on disinfectants. It's a reminder that sometimes it's the overlooked staples that can surprise you. Another hidden gem is Colgate-Palmolive. This company has been around for over 200 years and controls about 40% of the global toothpaste market. That's a staggering market share. It's a classic example of a company that's easy to overlook but hard to beat when it comes to consistent performance. Then there's McCormick & Company, the spice giant. While spices might not seem like a big deal, McCormick has seen steady growth as people cook more at home. Their ability to adapt and innovate, even in a niche market, makes them a strong candidate for a recession-proof portfolio. The key strategy here is diversification within consumer staples. By including a mix of well-known giants like P&G and these underrated players, you're spreading your risk and increasing your chances of steady returns. It's like building a team. You need both star players and reliable performers to win the game. One interesting fact is that smaller consumer staples companies often have higher growth potential. While they might be riskier, they can offer outsized returns if they manage to expand their market share or innovate successfully. It's a risk-reward balance that can pay off if you choose wisely. However, the strategy isn't just about finding the next big thing. It's about balance. You want a mix of stability and growth. The large, established companies provide the safety net, while the smaller, underrated ones give you that growth kick. This combination is what makes a portfolio truly recession-proof. In essence, don't just focus on the big names. Look beyond the grocery aisle and consider the underrated players. They might not be as famous, but they can add a lot of value to your investment strategy. By diversifying across the spectrum of consumer staples, you're building a portfolio that's both resilient and positioned for growth. Chapter 5. Value meets stability. Analyzing P&G's financial fortress. When you're investing for the long haul, stability is key. Procter Gamble isn't just a consumer goods giant, it's a financial fortress. Understanding the financial strength of P&G can give you confidence that your investment is safe, even in turbulent times. Let's start with their balance sheet. P&G has a rock-solid balance sheet with a debt-to-equity ratio of around 0.5. This is important because it shows that the company isn't overly reliant on debt. Too much debt can be dangerous, especially during a recession when cash flow might be tight. P&G's conservative approach to borrowing keeps them flexible and resilient. Cash flow is another area where P&G shines. In 2023, they generated over $16 billion in free cash flow. That's money they can use to pay dividends, invest in new products, or buy back shares. This consistent cash generation is a hallmark of a strong, stable company. It's what allows P&G to weather economic storms and come out stronger. Speaking of dividends, P&G's payout ratio, the percentage of earnings paid out as dividends, hovers around 60%. This is a sweet spot. It's high enough to provide attractive income to investors, but low enough to ensure the company isn't stretching itself too thin. It's a balanced approach that keeps both the company and its shareholders happy. Let's talk returns. P&G's return on equity, ROE, is consistently above 25%. ROE measures how effectively a company is using shareholders' equity to generate profits. A high ROE like this is a sign that P&G is making smart decisions with its resources. It's a key indicator of a company that's both profitable and efficient. P&G's strategy isn't just about financial metrics, though. They also focus on sustainable growth. For instance, they've committed to reducing their carbon footprint by 50% by 2030. This forward-thinking approach not only helps the environment but also positions P&G as a leader in sustainability, which is increasingly important to consumers and investors alike. Another interesting aspect is P&G's approach to pricing. They've successfully implemented premium pricing on many of their products, like Tide and Gillette. Despite economic downturns, consumers continue to pay a little extra for the quality and reliability these brands offer. This pricing power is a big reason why P&G remains profitable even in tough times. Finally, consider P&G's global footprint. They operate in over 180 countries, which spreads out their risk. If one region experiences economic challenges, P&G can rely on other markets to maintain overall stability. This global diversification is another layer of protection for your investment. In summary, P&G's financial fortress is built on a strong balance sheet, consistent cash flow, and smart resource management. By analyzing these aspects, you can see why P&G is a cornerstone of any recession-proof portfolio. It's not just about surviving the downturns, it's about thriving in the long run. Don't forget to subscribe so you never miss an update from us.